Welcome to Thoughts on the Market. I'm Martijn Rats, Global Oil Strategist and Head of the European Energy Team for Morgan Stanley Research. Along with my colleagues bringing you a global perspective, I'll be talking about the connection between oil prices and stock performance in the oil and gas sector. It's Thursday, August 5th at 5 p.m. in London. Although oil prices have rallied sharply over the last year, the performance of oil equities has been, rather modest by comparison. This begs the question, does the equity market actually believe the current price of oil? If we take a look at the oil and gas sector's performance in Europe relative to the wider European equity market and overlay that with the 2-year forward price of Brent crude oil, we see that oil equities have lagged the oil price rally significantly. If we take a step back and look at the historic correlation between oil prices and oil equities, these companies would currently be trading 50% higher or more if that correlation had been maintained. I'm using specifically European data here, but global data would paint a broadly similar picture. So we're asking the question, what's really going on here? There are different ways to interpret this result, but an obvious one would be to argue that this reflects a bit of skepticism on the part of equity investors that current oil prices are sustainable. And indeed, this would match some of the anecdotal feedback from investors. But this thinking stands in sharp contrast with the result of another piece of analysis. My team and I wanted to see how the performance of companies outside the oil and gas sector would correlate with oil prices. To dig into this, we simulated a long-short strategy based on the sensitivity of non-oil and gas equities to oil prices. To do this, we took the nearly 1,600 stocks in the MSCI World Index and stripped out the 46 oil and gas companies in that index. For each of the remaining stocks, we calculated the sensitivity, or technically called the beta, of its daily returns compared to the daily changes in the price of Brent crude oil for each month during the last 7 years. At the end of each month, we ranked all the stocks based on their beta to oil prices in that month. The subsequent month, this strategy then went long the 60 stocks that had showed the highest beta to oil prices, and it went short the 60 stocks that showed the lowest, typically negative beta to oil prices. So by now, you can probably see where I'm going with this. This long-short strategy also showed strong correlation with oil prices in the last few years. Naturally, the correlation with oil prices wasn't quite as tight historically as it had been for actual oil and gas companies, but still, in 72% of the months over the last 7 years, the return on this strategy and the monthly change in oil prices pointed in the same direction, meaning that non-oil and gas stocks saw benefit as oil prices climbed. Noteworthy, however, is that in the most recent oil price rally, this strategy would have performed extraordinarily well. Our analysis showed that the performance of this strategy even far outstripped what oil prices would have implied. So back to our original question, does the equity market actually believe the current price of oil? From this analysis, it's very clear that the equity market has few qualms about incorporating recent oil price strength into share prices. However, for a host of other reasons, it just doesn't seem to be expressing it in actual oil and gas stocks at the moment. Thanks for listening. If you enjoy Thoughts on the Market, please leave us a review on Apple Podcasts and share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.